Hi, and welcome to my monthly market insights video. My name is Dan Timitich. I'm one of the portfolio managers at T2 Asset Management. Before we get started, just remind you this video is for educational purposes only. Opinions expressed in this video are mine, do not reflect the opinions of other portfolio managers. You should always consult with a financial advisor before making any investment decisions. And remember, investments involve risk and are not guaranteed. Okay. So we've been hearing a lot of talk about the China trade deal, and I promised you last month that I was going to address some of the tariff issues as well as some of the trade talks, and in particular how tariffs are affecting economic growth. I think there's a lot of people out there that claim that tariffs stifle economic growth and cause price inflation, etc. But first, I just want to remind you, tariffs are not anything new. They've been around for a long time. As a matter of fact, the U.S. and other countries have had these for hundreds of years. If you just look at it here, back in the 1800s, the U.S. had tariffs as high as 57%. I mean, granted, worldwide now the tariffs have been coming down, particularly over the last 50 or so years. But even with them coming down, countries like China still have among the highest tariffs among the large economies. Now we have these Chinese tariffs. They've been in effect. They've been pretty high over the years, and we have to figure out, has that really affected their potential economic growth? And it hasn't. I mean, if you look at it, their economic growth rate has been about 12% compounded annually over the last 20 years. So these high tariff rates that they've imposed certainly haven't hindered their ability to grow. Now, I realize that many people say that tariffs are not measured very accurately. China and other countries, their tariffs aren't nearly as high as what's being reported. And I have to agree that, hey, look, tariffs are very, very difficult to measure. Some people may just calculate tariffs on a simple average where they take all the tariffs on all products and put them together and bam, there you go. Others may look at the trade-weighted tariff levels. So they'll take what's actually traded, what that rate is, and then apply that and calculate a rate. But either way, I think there's no single perfect measure for calculating these tariff rates. So I think it's important to just take a look at all of them and determine what it is that they're telling you. So let's do that. Here we have a bunch of different measures of how to calculate tariffs. The first column here is a simple average calculation that's done by the World Trade Organization. The other two columns are trade-weighted averages that are produced by the World Bank and the World Trade Organization. And as you can see here, regardless of the methodology, the countries with the highest tariffs are still 1, 2, and 3, Brazil, China, and Mexico. So I think this is a really good indication that while the calculations may vary significantly, the actual results tend to be quite similar. Now here we have a little bit of a different chart. It was produced by the World Bank. It uses a simple average. But looking at the major trading partners of the United States, we can see how big the tariffs are in China and in Mexico in particular. Granted, they have been coming down, but you can see that they were significantly higher back in the early 2000s and continue to remain very high. If you contrast that with the other trading partners, you can see how much lower the tariffs are in the United States, Germany, Japan, and Canada. You could also look at this in a different way, so you could pretty much depict how much lower tariff rates have come down for China and Mexico, while at the same time you see countries like Germany, United States, Japan, and Canada, they've had pretty stable tariff rates. So I think there's a lot that's been overblown on how protectionist, I guess, the United States has become with these additional tariffs that they've imposed on China and potentially other countries. So let's just jump into the trade negotiations with China. I think there's generally four possible outcomes of the trade negotiations with China. Option one, trade war escalates. U.S. imposes more tariffs, China retaliates, or vice versa. Either way, it would continue to depress both economies at a time where economic growth is weakening. So I think this is a highly unlikely outcome. Option two, trade deal gets done here in 2019. Somehow China agrees to everything and Congress approves the deal. This too is highly unlikely. There is very little chance to no chance that a Democratic-led House is going to give Trump such a big win going into the 2020 election. Option 3, China waits until the 2020 election. This would be a big gamble on China's part, I think, hoping to get a pro-China type president in the United States. If they do gamble and Trump gets reelected, not only is the administration going to be empowered, but China's going to get a much, much worse deal and potentially even risk economic collapse. So again, this is an unlikely situation or scenario. And finally, option 4, China simply waits to see who wins the Democrat nomination for president. China is not going to be in any hurry to do anything major on trade until they see who the Democrats are going to run. They do risk Trump adding more tariffs and or sanctions, but I think China is willing to wait and see what happens. This is probably the most likely outcome. Look, there may be some small progress on trade along the way, but I don't expect anything significant until the Democrats wrap up their primary. Depending on who that nominee is, Trump can certainly put the screws to China and force them to do a reasonable deal before the elections, or risk having to concede a great deal if Trump does get reelected. We're just going to have to wait and see how this movie plays out. But again, I think this is probably the most likely outcome, that China just delays until after the Democrat primaries, and then we start to see some progress on trade. Okay, so given all of that, let's take a look at what September looked like. Obviously, trade concerns, Brexit, Fed funds rate cuts, slowing economic growth all caused a great deal of volatility in the third quarter. September, in general, was pretty good. We saw all the major averages post decent returns, especially after a tough August. But what concerns me is how strong the performance was with long-term treasuries. The bond market is signaling something of concern going forward. So I think it's very important for people to pay attention to this and not just ignore this altogether. Looking at sectors, we saw a similar story with utilities doing very, very well. The only other sector that performed better than utilities was tech. Generally speaking, that said, all sectors are doing well. The only exception is really healthcare and energy. So where do we go from here? Well, my short-term model has turned negative at the end of September. And so I started increasing my cash position then. It did go more negative in October, and so I went and built up even more cash, and that reduced my stock exposure by about 35%. This doesn't necessarily mean that we're in for a huge sell-off, but it does indicate some problems in the market. This same model went negative back in October of last year, as well as in May and August of this year. We all remember what happened in the fourth quarter of last year, but we also saw the market sell off just about 7% in May, but it was only 2% sell off in August. So at this time, we don't know what October will look like, but I'd rather be a bit cautious here. Within my stock exposure, I did reduce higher volatility positions in favor of lower volatility positions, but I do continue to maintain exposure to the U.S. consumer, both on the discretionary and staples sectors. I think the U.S. consumer is still strong, and I see little to any concern with regard to the consumer. Now, I realize that, given a run-up that we've seen this year and markets seem to only go one direction, that risk management doesn't matter. But given how much risk there is in the market based on a single headline or a tweet or some random data point, I do expect to be more active in the coming months. It's pretty clear that the fundamentals of the economy are fine. They're just not great. If our economy was positioned to grow at a 3 or 4% kind of annual growth rate, I don't think you would see such huge swings in the market that are based on whether or not a Chinese delegation attended or didn't attend a meeting. I think algorithms and the sensitivity to trade talks and Fed rate cuts is really what's driving the markets now this year, and what it will drive markets in the coming months. So I think it's going to be a challenge, but I don't foresee any kind of recessionary problems going forward, but it will require that people become more active. Thank you all for watching. I hope this video was helpful. And if you have any questions on anything in this video or just want more information, don't hesitate to call or email me. Thanks again. Hope to see you next month.